All right, so welcome back to the streaming section for today. So today we're gonna have three activities. One, you're gonna take into account Q&A section, questions on financial accounting that you don't understand. You want to throw in the live chat section for us so that we answer it for you. Then two, we also want to look at uh bank reconciliation as part of the financial accounting uh, issues that we need to understand as a basic way to understand financial accounting better. And most important, three, we are also going to look at control account as also a basis for adding up to how you also prepare accounts in relation to that. So, if this is your first time, do what subscribe, like, and share the video. If you are an old member here, you have been with us for as many years, thank you always for joining us always together on this channel. So do want to share the video so that others will get the benefit to always to join us in that particular case. So let me throw in my board so we get started without wasting my time and bring up my board so we go. So let's go. Let's go. Straight up. Let's go. Bring up my board so we go. Okay, here we go. All right, so welcome back once again to the live section today. So today we are looking at financial accounting, and our focus for today's section is going to be on bank reconciliation statement and control accounting or self-balancing ledgers that you want to understand. So it's also one of the fundamental topics in accounting that we need to understand. So far as our double entry system and preparation of what financial statements are concerned. So we want to make sure that you understand these principles so better so that going forward you should be able to excel and then pass. So do want to share the video, like it as well, my issue for you to share the video. Share the video so others will get joined as we move along in that particular case. So let's begin the discussion without wasting my time. So we are looking at bank reconciliation statement as a beginning. Then the next, we throw in the control account. As usual, if you have any question, you want to throw in a chat for us so that we go in that particular case. All right, so let's begin the discussion going. We are going to look at bank reconciliation statement. Bank reconciliation statement. Bank reconciliation statement. So let's begin like this. Let's say we have Mr. A, or let's say, let me have a proper name for this situation. Let's say we have Mr. Moore. Mr. Moore. All right, this is Mr. Moore. Okay, this is Mr. Moore. Uh, this is Mr. Moore. Okay, and Mr. Moore is actually a customer of a particular bank, say bank. So let's indicate like this. This is the bank actually. This is the bank. So Mr. Moore is a customer. Just want to follow carefully. All right. Mr. Moore is a customer. And then this is the bank. So we have what bank? I'm presenting this form like this. So bank. Now, Mr. Moore on one side, being the customer of the bank, always make what? Deposit into the bank. He always make deposit into the bank, and withdrawals are also made by Mr. What? Moore withdrawals. So he make deposit of all forms, right? He made deposit of all forms, and as well, withdrawals are also being made by Mr. Moore withdrawals. Withdrawals. I don't know whether my spelling is right for that, but withdrawals should be able to help us to go generally there. So withdrawals. Okay. Now what is happening here? A particular period, Mr. Moore received a statement from the bank. Mr. Moore received a statement from the bank, and this was the statement. This was the statement that Mr. Moore received from the bank. This was a statement. So statement. Mr. Moore received what? A statement from the bank. And the bank was saying that, hey, Mr. Moore, at the end of the period, this is what you're having in your account. Say, $1,000. But Mr. Moore was confused and was angry. As hey, what are you people telling me? In my cash book or in my Momo account, I have an amount like 1,400. And what are you people telling me that I have what? $1,000? What the heck? So what is happening here? He's confused. I mean, he want to throw in some punches to the bank, not knowing what to do. So he is confused generally here. So what should Mr. Moore do? Then Mr. Moore make a journey to the bank. Then, hey, see this bank? No, I need to go to the place and find out what is happening. Because I know in my cash book I have 1,400, but this is what the bank is telling me that, hey, you have what? Just what? $1,000 in your account. What is happening? So he went to the bank and then make further inquiries about what is happening. And then when he went to the bank explained everything to him. And then Mr. Moore was what? A bit okay and would calm down. So what do you think would have caused what? The difference between Mr. Moore bank account amount he's supposed to have in his cash book and what the bank sent to him as a bank statement balance. What do you think it would have been? This is what bank reconciliation or a statement called reconciliation statement comes in to resolve these discrepancies. So in our discussion, we are going to look at bank reconciliation statement. It is a statement prepared to reconcile the difference between the bank statement balance and the cash book balance of the customer. That is how a bank reconciliation statement comes to town. It is a statement prepared to reconcile the difference between the bank statement balance and the cash book balance of a customer. So once you know that, okay, you are going to prepare a statement to reconcile that, then what are the things that cause the amount that we're supposed to have in our cash book, in this case, Mr. Moore account, to be 1,400, but the bank sent in a statement saying that, hey, you have just $1,000 in your account. What are some of the things that will actually cause that? Then we want to look at some of the items that we'll call a differences. In other texts, they will call it as well discrepancies. Discrepancies associated with what? The differences between what? The bank statement balance and a cash book balance. As usual, we are bringing some new term, bank statement and then a cash book. You and I know that at this level, we're supposed to have a bank account. So there are times where you check your account with a bank and you check, what you supposed, at times, let me give a practical example here. Let's say you always make a deposit withdrawal to your Momo account. In a particular point, you made a deposit from your Momo account to the bank. You know that you made actually 200 Ghana to the bank, but for a few hours, you check that deposit that you made, it was just 1,500. I said 1,500, 150. But you know that you actually sent what? 200 Ghana cedis. What is happening? That means there is something that actually has what occurred that has caused the amount that you actually sent not being the same as the one that the bank is what having as your balance. And these are some of the things we're going to look at as an item that causes discrepancies or differences between a bank statement balance and a cash book balance. So these are the things that we need to understand when it comes to what bank reconciliation statement. So now we are bringing in cash book, bank statement. What is a cash book? A cash book is like a normal book that you know. Okay, a normal book that you know. Cash book is like a normal book that you know. So let me bring in something like this, something small. Let's say this is my book. Okay, so this is my book that I have as my cash book. Cash book. So within the cash book, right? Any amount that you make if it's a deposit, then let's say we reflect it here. Deposit will be here. Deposit. Deposit will be here. And any withdrawals that you made too will go to this side. So at the end of the day, we expect that deposit withdrawal by the customer will have the same effect as what will happen in the bank statement. So a cash book is a book kept by the customer to record an item of what? Cash deposit or cash withdrawal at the end of the day. It deals with what recording of transactions with respect to cash or check only. The emphasis here is only cash or check what only in the form of a deposit or a withdrawal. And cash book is also one of the fundamental ledgers that we use in the recording of our transactions in the book of accounts. Okay, so that is a cash book. What is a bank statement? So a bank statement to also have something like this. You have a detail. So you start from date section. We have a detail. We have a column called something like folio there. Depends on your bank. You may have a debit, you may have a credit, and you may have what? A balance. A balance. You may have a balance in that form. So at any amount that let's say you make a deposit, when you make a deposit on your cash book, you record it here as a deposit. But to the bank, since it's an item they are going to receive on your behalf and the money doesn't belong to the bank will take it as a credit on your account. So when you make withdrawal too, you know that it is happening at this side, withdrawal. Here it is happening at this side, and the bank will also take into account making a deposit, a debit word entry in that, so that at the end of the day, it will agree. This is how the bank statement also. So it's a statement that is what sent by the bank to the customer periodically detailing all the transactions that has occurred within the customer's account. Let me take it again. A bank statement is a statement prepared by the bank and sent to the customer of the bank, detailing all the transactions that has occurred for a particular period of time. So at any time there is a deposit in the cash book of a customer, it reflects as a credit balance in the customer's account, with the bank. But anytime there is a withdrawal, it also reflects at the debit side of what the customer's bank account that they have with the bank. In this case, Mr. Mua, if you make any deposit, it's going to be at this side, the debit side of his cash book. But when you make any withdrawal, then certainly at the credit side, and the bank will take what? A debit entry there to make a reflection. These are the basic principles that we need when it comes to recording in the cash book and then the bank statement by the bank. Another thing that we also need to take note here is that cash book is actually prepared by the customer of the bank, but bank statement is prepared by the bank. It's prepared by the bankers or bank, something like that that you want to take it for short. Okay, so that is another thing that you also want to understand. So a bank statement is, as I said, sent periodically to a customer, detailing all the transactions that has occurred in the customer's account. Okay, so once you have gotten that, that is fine. Now we also establish fundamentally that if there are discrepancies, as in like our case in Mr. Moore and the bank, he's supposed to have 1,400 in his cash book, but the bank, through the statement that he received, informed us that he was having what $1,000. So what will have been some of the issues that have caused that difference between the 1,000 and the 1,400? So we jump straight to also to look at the issue about what differences or discrepancies. So let me make it a simple, in a simple form for you. Differences between, let's take it like this, between what a statement bank statement balance and a cash book and a cash book balance. So what do you think are some of the issues that can cause differences in respect to the total balance that we're supposed to have in our bank statement and that of the cash book that the business keep as an organization? What are some of them? So under that, we are going to categorize in three forms. We're going to have first one called, or A, I call it as what? Unrecorded items. Next, we also have B, called omissions, generally omissions. And then the last part of the discussion, so let me throw that here, omissions. And the last part of the discussion is what we called C, what we called what? General errors. So these are the broad issues that will always cause a differences between a bank statement balance and a cash book balance. So let's take note of that. Any question you want to throw in a chat for us, so that we'll take it from there generally there. So that is the issue that we want you to understand when it comes to bank reconciliation statement. We have unrecorded items, omissions, and general errors. All right, so that is the whole idea you want to understand generally here. Okay, once we have gotten that idea, then let's bring in those items so that we can then take it from there. So unrecorded items, let's define the simple short. Unrecorded items are generally items, right, or items that cause discrepancy between what a bank statement balance and then a cash book balance. And these are the items in which the customer of the bank, in this case Mr. Mua, has recorded it in his cash book, but the bank has failed not to record in the bank account of the customer. before, or yeah, before, let's say, sending the bank statement, something like that. So unrecorded items are items that's been recorded in the books of the customer, but failure on the bank side also to record in the account of what the customer. These are what we call unrecorded items. And unrecorded items comes in two forms. We have one called unpresented unpresented checks. We have unpresented checks, right? And we have what? Uncredited checks. Uncredited checks. These are the two forms that will cause what? A bank statement balance not to agree with that of what? A cash book balance with respect to unrecorded items. And we said unrecorded items are those items that the customer has already made a records in his or her books, but on the other side of the bank, they fail not to what? Record it. This is what we call unrecorded items. So that means that unrecorded items are items. They are errors that cause discrepancy between cash book and bank statement, which is always coming from what? The bank. So we can therefore make a conclusion that unrecorded items are errors of what? The bank. They are errors made by the bank. Errors made by the bank. We can have that short here. Errors made by the bank. Errors made by the bank. These are what we call what? Unrecorded items. So therefore, to correct that, the bank needs to what? Record it. And we'll get back to this recording issue as we move along the discussion. So that is unrecorded items. B, omissions. What is omission? When we talk about omissions are generally where the item is totally not what? Recorded. So here, the emphasis here is that it is totally not recorded, totally unrecorded omissions. So the emphasis here is that totally unrecorded, totally what? Unrecorded, unrecorded, totally unrecorded. So we have what? Totally unrecorded, totally unrecorded. That is what? Omissions. So when the transaction is not totally recorded at all in the books, we call it what? Omissions. And omissions here can affect the two parties. It can be an error from the bank, or it can be an error from what? The customer. So that means that omission error, there are errors that cause discrepancy between the bank statement balance and the cash book balance, which is coming from both what? The customer of the bank and the bank itself. So here it is errors made by both what? The bank. So there are errors. So like bring in that errors. So there are what? Errors made by both made by both what? Made by both the bank, moved by both the bank and the customer. Made by both the bank and the customer. Made by both the bank and then the customer. These are what we call omissions. So under the omissions, we are going to look at omissions that can come from what? The customer of the bank, and then that can also come from what? The bank, before we come back to the general errors issue in that particular case. So when we talk about omission from that of what? Or omission coming from the customer of the bank will be errors that will be found in the customer's what? Cash book. We'll look at some of these issues as we move along the discussion. Omissions which are caused by the customer of the bank will always attributed from the cash book. So that means at the end of the day, we need to update the cash book to adjust for those errors. So some of the omissions coming from the customer, So customer's omission. Let me put something like that just for you to appreciate what I'm trying to build up here. Customer's omission, we may have one. We have general errors that can come in there, but what can one do? So customers' omissions are generally the errors that you must adjust in the cash book. Something like things that the customer did not record. So you may have something like what standing order, standing order. So standing order. And I think by that, then my definition for omission needs to be changed. I said it's committed by both word. Yeah, there are times where the bank can make commissions, but generally, with respect to what we are doing, if I'm bringing in standing order, a standing order is an item that will be found on a bank statement, but will not be found on the cash book. So fine may be committed by both what the customer and the bank, but generally omissions are errors coming from what the customer of the bank. So let me make that correction there so that you know what you are learning generally here. So there are errors made by just the customer of the bank there, right? Though we may have some form of what omission by the bank, but for the most part, there are errors made by the customer of the bank. Made by made by, so let me bring in this one. Oh, come on. Made by the customer of the bank. That is what an omission. So there are errors that the customer failed not to record in his cash book, but it has been recorded by what the bank. So let's throw in that. I thought I was discussing general errors there. So that is automation. But unrecorded items are items that has been recorded by the customer, but not recorded by the bank. So that's why we said errors made by the bank, made by the bank. But here, they are errors made by what? The customer of the bank. Okay, so that is a correction that we need to have. So let's take it like that. So we have standing order. We also have commission on turnover, commission on turnover, commission on turnover. You may also have issues like bank charges, bank charges. We also have what again? Standard order commission on turnover, bank charges, etc. We have a lot of errors that the bank can what? I mean that the customer will unable to what record. So the customer is unable to recall because as at the time the customer was preparing what his balances in the cash book, the bank statement was not available. So he can't make these entries in his cash book. So what are these errors that we are trying to talk about? I think I didn't define the unpresented checks and uncredit. So let me come back to that before I come to the customers with omissions so that we appreciate the definition behind. So going forward, we know that we are working with the meaning behind what we are learning. Okay, so when we talk about unpresented checks, there are those checks that it has been recorded in the books of what the customer. In this case, it has been recorded in what the cash book of Mr. Moa, right? As what a credit item. Because when we present a check, there are those checks that we are using to make what payment. So when we are making payment, it possibly that it's going to reduce our balance in our cash book. So when there is a reduction in our balance in the cash book, we will credit our cash book. That's why you see the part as withdrawal. So withdrawal means it can be that we are making payment. So there are those checks that the business has sent to or issued to its suppliers for payment, but on one side, the supplier did not present what the check to the bank for what payment as at the time the bank statement was sent. This is what we call unpresented checks. They are those checks which the business issued in the form of a payment to suppliers or whatever form. Once it's issuing, that is fine. That's going to be at the credit side of the cash book as what a withdrawal. But unwilling on the other side of the supplier to present the check to the bank for payment as at the time the bank statement was sent. So we realize that it's good. Unpresented checks will always be at the credit side of the cash book, but not at the debit side of what the bank statement. This is what we call unpresented checks. Unpresented checks. So let's take note of that. Unpresented checks. The opposite is true. Uncredited checks. There are those checks too that the business also received from their customers, right? But on one side, the business failed not to what accepted by the business will not to. There are checks that the business received from their customers and they recorded it at the debit side of the cash. That is, they made a deposit. Once they receive it, they make a record as a cash, because when cash is received, the double entry is saying that we debit the cash book. And then we send the check to the bank, but the bank failed not to record that check as at the time the bank statement was sent. That would mean that, hey, we will have uncredited checks at the debit side of our cash book, but not at the credit side of the cash book. This is what we call uncredited checks. They are those checks that the business receive from its customers as a form of payment. The business make a deposit in the cash book as a debit side, but send the check to the bank, but the bank fail not to actually deposit at the credit side of the business account. There are a lot of reasons why the business, as at that time, may not make that deposit in the customer account. Possibly because it's a cross check, so they have to check to see if the check is actually original check, it is coming from a good source. Nobody has tampered with the check and that kind of stuff, right? So before the bank will record those checks, they must do background checks before they can do that. So that delay before the bank statement will be issued can cause that discrepancies between the cash book balance and the bank statement balance. This is what we need to know when it comes to unrecorded items, unpresented checks, uncredited checks. So unpresented checks will be at the credit side of the cash book. Credit side of the cash book, okay, but uncredited checks will be at the debit side of the cash book, but not at the credit side of the bank statement. All right, and we said that in that, so it's going to be an error committed by the bank. Then omissions, and then we discussed that omissions are generally errors that is coming from the customer of the bank. Something that the bank has recorded, they have done their part, but as at the time the bank statement was received, the customer wasn't having any information about these transactions that occurred in his bank account. So from there, they only look at standing order. What is a standing order? So when we talk about a standing order, let me give a simple short for you to understand. A standing order. Let's say you're a government worker, or let's say you own your own business. You're a big man or a big woman in town with a business mind generating huge sums of money, cash flow here and there. And then one day you went to the bank and say, hey, bank, my bankers, here's what I want you to do for me. I have certain charity home that I want you people to, at every month, make some transfer to that charity home. Okay, so if you want to make those transfer to that charity home, that is fine. That is perfect. So what is happening here? That means you are giving the bank an instruction that, hey, at the end of every month, transfer so amount into that charity account on behalf of me from my bank account. Okay, so you made that written instruction to the bank that, okay, we should do that. That is a standing order. For a particular period, you went to the bank and realized that, hey, the amount supposed to have my bank account is different. And then when you go to the bank and then you make an inquiry, they then refer you that, if you remember, you made an agreement with us that every month you must transfer this also amount to that charity. Then say, okay. That is why your account is like that. So standing order is also an item that can cause discrepancies between a bank statement balance and the customer, and it is a written instruction by the customer to the bank, ordering the bank to make certain payment or make certain transaction on behalf of the customer, and that also goes for a fee, because when you are giving a special tax to your bankers, that means that you must pay commission on it, and that can also mean commission on turnover. It can be something that the customer will receive from engaging a transaction with a third party, in which there is a process that you receive, or it can also be something that from the perspective of the standing order that you are giving to the bank, that they're going to pay commission or fee on that, and also that also have a relation with the bank charges generally there. Because at the end of the day, when the bank, let's say when you open a bank account, the bank will give you a cash book as a cash book, this checkbook. They'll give you a checkbook, and the checkbook wouldn't be given for free. You have to pay for it, right? So when that checkbook is paid, it's part of the bank charges that at the end of the day you are going to pay, and that's going to affect the debit side of your bank statement. So as at the time you receive the bank statement, you wouldn't be aware of these information, and these are what we call omissions. That means as at that point you haven't having that information, so it becomes generally an error that you fail not to record, but the bank has done their part. So all errors of omission can be traced from the bank statement. All errors of unrecorded items can also be traced from the cash book of the customer. And the most important, the last thing, is also about the general errors. We'll look at some of these customers omission when we take some of the examples so that you appreciate it more. But for now, let's keep these three. As we move along with take questions, you understand what I'm trying to build up generally here. And the general errors are the errors that has been committed by both. So here that the emphasis should be both bank and what? So both the customer and the bank. So both the customer and the bank. So it's both the customer and the bank that commit such errors. And it can be, general errors like an overstatement or understatement. Overstatement means that, hey, the amount supposed to record in the book, it has been recorded in excess. Or understatement also mean that, hey, the amount you recorded has been recorded below the actual amount that you're supposed to record. This is what we call overstatement and understatement. And we can also have one key error that you always want to see in the information that you're given as part of the question: wrong debit, wrong credit. In most cases, these errors can be committed, as I said, can be committed by both the customer of the bank and then the bank itself. So the errors under that, we may have let me bring in this so that we may have one overstatement and one that. So let's say we call that as casting errors. When we get to correction of errors, you appreciate this. But for now, let's keep this casting errors. Casting errors. Call it overstatement or understatement of errors. Then we have wrong debit. We have wrong debit and then wrong credit. Wrong credit. We'll look at these issues as we pick a question and then explain the concept. But generally, when we talk about wrong debit, it is something that's supposed to be done at let's say at the credit side as right, but you made mistake and you debit it. So that is a wrong debit. And wrong credit is the opposite. You record it at debit side, but you record it at the credit side. Or possibly it's supposed to be at the credit side too, but the figure that you recorded is different from the amount you're supposed to record. You can also call that as a wrong credit. So when we get to the pro forma for the operation of the bank statement, I'll show you how we treat wrong debit and wrong credit soon. So let's take note of that. So this is how, or these are the issues that cause discrepancies or differences between the bank statement balance and the cash book balance: unrecorded items, omissions, and general errors. Unrecorded items are errors made by the bank. These are unpresented checks, uncredited checks. Omissions are errors made by the customer of the bank. These are, some of them are standing order, commission on turnover, bank charges. We will discuss some of these issues when we take example and you see how they take effect. And general errors, we said it is both for the customer and then the bank. And we discuss some of these issues are casting errors, wrong debit, and wrong credits. And there's the bank statement that we throw in there that you may have a date, details, folio, debit, credit, and the balance. So when there is any deposit that you want to make, you record at the debit side of your cash book, and then the bank will credit you. If you are making a withdrawal, you credit your cash book and then the bank will debit you. All right. So these are how the cash book and then the bank statement operates. The operation of the cash book and bank, this is how it occurs. So that we agree or we follow the double entry principle in that particular case. So let's take note of that. Okay, so now let's move to the pro forma for the preparation of balance. So that after that, we'll take a question and then we are off. Then we look at the control account issue and then we move. So let's look at the pro forma. Any question you want to throw in the chat as we move along in that particular case. Where's my cursor?